Hello, my name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Valuator, the #1 financial analysis software tool in the self-storage industry. And today, in this episode, let's talk about cap rates. That's a term we hear banished around quite a bit. We bought on a 7 cap. The REITs are paying a 5.5 cap. I don't buy unless I buy a 10 cap. But what exactly does that mean? Well, there are a lot of complicated definitions about what a capitalization rate is. Cap rate is short for capitalization rate. And as a CCIM, which is a designation you go through in the real estate industry, the commercial real estate industry. When I got it in the 90s, it cost about $10,000 a letter, almost. We spent a lot of time on analyzing and calculating cap rates. That's the formula that the industry uses to compare one asset against another. It all comes down to cap rates. Well, I'm a pretty simple guy. Obviously, because I'm in self-storage, right? I have to break things down to a very simple way to relate to them if I'm going to use them as I'm out in the marketplace or out in my daily life working. So, how do I relate to a cap rate? Well, here's how I relate to it. Forget the fancy definitions. If you like this, use this. So if I paid all cash for any type of investment, real estate investment, what would my return be in year one? Whatever that return is my cap rate. You see, every income producing piece of property, whether it's self-storage or office or retail or apartments or whatever, you have an income stream, you have your operating expenses, and operating expenses are the taxes, the insurance, the management, the utilities, what it takes to run that facility. What's not included in operating expenses are your loan payment, capital improvements, like if you put a new roof on it or put a new parking lot in, usually big ticket items that are depreciated over a shorter period of time. Those are capital expense items. As we're analyzing property, we put those below the net operating income. But every property will have income, which is usually rent, operating expenses, and then that cash flow left over, that's the number we always want to get to. That's called the net operating income, or the NOI. So in year one, if I bought a piece of property and the NOI in year one gave me an 8% return on what it cost me to buy that, I purchased it on an 8 cap. That's how simple cap rates are. We use cap rates to come up with a price. So if we know what the NOI is and we apply a cap rate to it, I can tell you what someone paid for it. So how does that work? Well, let's go to the computer and look. Okay, so here we are at the computer, and let's talk about cap rates. So like I said earlier, every income producing piece of real estate has income, or hopefully it has income, or it will soon have income. And in most cases, the income is rent. Then you have the operating expenses like we talked about. So if you take the operating expenses from the income, that gives you a number called the net operating income. So you could buy, that's the number we always try to get to. You know, you could buy a property all cash, or you could buy a property with 100% debt on it. It really doesn't matter. That would affect your cash flow, but it would not affect the net operating income. So what is a ready, willing, and able buyer willing to pay for this net operating income? Whatever they are willing to pay is the cap rate. So to get a little deeper understanding of this, let's look at two fictitious pieces of property.
The first one is what we're going to call a triple net lease property. Let's call it a Walgreens. And a triple net lease property just means that the tenant pays all of the operating expenses. Tenant pays maintenance, taxes, insurance. If the building burned down, the tenant would build it back up. All that happens here is that the owner walks to the mailbox to get his check. This is about as low a management type of real estate as you can get. Now, for an investment where all the owner has to do is walk to the mailbox and get a check, what type of return would the market demand for that type of income stream? Well, let's take a look and see. So let's say that the rent is $100,000. Let's say the Walgreens is paying $100,000. It really wouldn't be that. It'd be much more. But in this scenario, let's just say it's $100,000. Of course, in this case, the operating expenses are zero to the owner because the tenant pays it all. So the net operating income is $100,000. So for this mailbox type money, let's just say that a ready, willing, and able buyer would demand a 7% return on his money for this type of investment. So that would mean the market cap rate is 7% for this type of triple net lease property. In reality today, it's probably lower, but 7% was a very realistic cap rate a few years ago. It will probably get there again. So to calculate what a ready, willing, and able buyer can pay for this property to get that 7% return, all you do is take the net operating income and divide it by 0.07. So a ready, willing, and able buyer can pay $1,428,571 for that $100,000 cash flow and get a 7% return. Well, let's look at another kind of property. And I just chose what we're going to call, let's say, a low income tax credit apartment complex. This is a much more management intensive type property. You don't have to walk to the mailbox to get money. In this case, you're probably knocking on doors to get money. The income stream is a lot less secure than Walgreens, which is a publicly traded company. There's just a lot more moving parts to this, and the more moving parts, the greater the chance for an interruption in the cash flow. So let's just take a look at this asset here. So let's just say the rent here is $200,000 on this complex. The operating expenses are $100,000, and the net operating income is $100,000, just like the Walgreens. However, you would probably demand a much higher return, a much higher yield on this investment because of the management intensity. So let's just say it's 12%. In other words, I would need to buy that NOI at a price that would give me a 12% return on my money because of the management intensity on this. So let's just say that would mean the market cap rate is 12%. So again, to calculate the purchase price, you would take that $100,000 cash flow and divide it by 0.12. And that puts a value of $833,333 on that $100,000 cash flow. So it's very interesting here is that both properties had the same net operating income, but they had very different values because of the cap rates. So you can see that a movement downward of a cap rate from 8% to 5% or 8% to 7% will create a much higher sales price. And that's what we're seeing in real estate today. What we're seeing is cap rates going down, particularly in self-storage. So just remember, the lower the cap rate, the higher the value.
So I hope this has been helpful in how you relate to cap rates and how you can use it next time you're looking at a piece of property or you hear someone talking about what they bought on whatever cap rate they paid. But just as a side note, we're in the self-storage business. And what's beautiful about the self-storage business is that other than your loan payment, in most years, in most cases, your NOI minus your loan payment is your yield. You know, we budget every year. We put a portion of our cash flow in a capital reserve account, and then when we do have capital expenses, the money's there and it doesn't come out of our operating account for that year. And I can project very accurately when I'm going to spend those capital improvements. So in most years, other than the debt service, subtracting the NOI and telling me what my distributable cash is, in our analysis, we usually just have debt service and our reserve fund, and that's our distributable cash. There's very little other pressures against that NOI number. Unlike apartments, where you got toilets to replace, walls to paint, carpet to replace, appliances can be replaced. If you own a 60-unit apartment complex, how many appliances do you replace a year on average if you want to keep your asset up? Office building, don't even go there. If you're not have a lot of money stocked away somewhere, if you own office buildings, Lord help you, because I'm telling you, you'll spend that money. I've seen the distributable cash vary wildly as I manage other type assets. In self-storage, there's no commissions, there's no tenant improvements, there's no capital expenses you can't budget for, or rarely. That's why we love it. That's why we're in self-storage. This industry is growing and evolving. We've got to go to the next level with it, and part of that is understanding cap rates and the financial analysis aspect of it. Believe me, your competition does. So it's all up our game. My name's Mark Helm, and I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Valuator, the #1 financial analysis software tool in the industry. Thank you for watching this.